about how many of us, when we start a new job or, get that annual benefits update, we kind of quickly scroll through.
Right. Tick a few boxes.
Yeah, tick a few boxes, move on. And right there, often included, is group life
It's
insurance.
just there.
Exactly. It's convenient, it's offered, but, well, do we really understand what it is, how it fits into our overall financial picture?
Probably not always.
So in this deep dive, we're going to unpack group life insurance. We've got a foundational chapter here that lays out all the essentials.
The fundamental.
Yeah, our goal,
Mm.
to pull out the key principles, the real advantages, and, the critical distinctions of group life insurance.
Okay.
So that you, the listener, can truly understand this important benefit and how it operates for you.
What's fascinating about group life insurance is its fundamental approach. It's about providing coverage efficiently, to a lot of people under one single umbrella.
Right. One policy for everyone.
Instead of many individual policies, yeah.
Yeah.
We have one master contract, typically offered through an employer. You can think of it as a form of annual renewable term life insurance, but scaled for a group.
Okay, let's dig in there.
Oh.
So it covers multiple people, often within a company. You mentioned annual renewable term. What does that practically mean for someone compared to, like, a policy they might buy themselves?
That's a really important distinction. Individual life insurance, it can be term, right? Covering you for a set number of years.
10, 20 years, something like that.
Or whole life, which offers lifelong coverage and a cash value component.
Okay.
Group life insurance, being primarily annual renewable term, well, means the coverage is for 1 year at a time.
Just 1 year.
And the insurer guarantees it can be renewed annually, though the premium might be adjusted.
Okay.
Another key difference is in the underwriting.
Underwriting.
Here.
How they decide if you're insurable and what to charge.
Exactly. For an individual policy, you usually need to provide detailed health info, sometimes even medical exams.
Right, the whole process.
With group insurance, the focus shifts. It's more about the characteristics of the group as a whole.
So less about my personal medical history, maybe. More about the overall profile of the company offering the plan.
Precisely.
Does this mean someone who might, say, have trouble getting an individual policy could still get coverage through work?
Exactly. That's a huge potential benefit. And when we consider who holds the reins, in an individual life insurance scenario, the person insured is typically also the policy owner.
Makes sense. My policy, I own it.
But with group life, the employer generally acts as the policy owner. They hold what's called the master policy.
The master policy.
And the employees who are covered, they receive a certificate of insurance.
The certificate.
Yeah, which serves as evidence of their coverage under that master policy.
So that certificate, it outlines what's covered, the amount, maybe the beneficiary rules, that kind of thing.
Right.
A summary from the big master policy.
Precisely. It's your proof of coverage. And it's crucial to understand that in group life insurance, the employee almost never owns the actual policy itself.
Right, okay, the employer owns it, I get a certificate.
Right. Now, while employer-sponsored plans are the most common, the definition of an eligible group, well, it extends beyond just workplaces.
Oh, like what else?
You can find group life insurance offered through credit unions, labor organizations, even groups of smaller employers banding together,
Interesting.
professional associations, sometimes alumni groups, and in some cases even customer groups or trustee groups.
Wow, that's a much wider net than I probably would have guessed. But there must be some rules, right, around forming these groups. Could, like, a bunch of friends just create a group to get cheaper insurance?
That's a critical point. No. The key here is that the group must have been formed for a purpose other than just obtaining insurance.
Okay, so there has to be a primary reason for the group to exist first.
Exactly. The insurance coverage should be sort of a secondary benefit of the group's existence. A company exists to do business. A union represents members.
Right.
The insurance is a valuable add-on to that main purpose.
That makes sense.
Yeah.
Stops people from gaming the system. Now, the material we looked at also talked about contributory and non-contributory plans. How does that affect the employees?
Good question. In a non-contributory plan, it's simple. The employer foots the entire bill.
The whole premium.
The whole premium. It's a fully employer-paid benefit. And because of that, the insurance company typically requires 100% of eligible employees to participate.
Everyone who's eligible has to be in. Why is that?
Well, this high participation is actually a significant advantage for the insurer. It helps to mitigate what's known as adverse selection.
Adverse selection.
Yeah.
Okay, that's the worry. That only the people who think they need the insurance most, maybe less healthy people, are the ones who sign up, right?
Hmm.
Skewing the risk pool.
Exactly. So requiring everyone to participate in a non-contributory plan helps balance out that risk, makes the pool more predictable.
And for the employee, well, it's a completely free benefit. Can't argue with that.
Precisely. Now, in contrast, you have a contributory plan.
Okay.
This involves the employer and the employees sharing the cost of the premiums.
So I'd pay something out of my paycheck.
Potentially, yes. In these situations, insurers usually stipulate that at least, say, 75% of eligible employees must choose to participate.
75%. So not everyone has to, but a strong majority.
Right. If the participation rate falls below that threshold, the insurer might actually not issue the policy or might reconsider the rates.
Okay, so it's about who pays employer only, or shared, and what percentage needs to opt in.
Mm.
What about who is actually eligible to be covered in the first place? Are there typical criteria?
Generally, yes. There are a few standard requirements. Employees usually need to be classified as full-time
Full-time, okay.
and actively working, not on extended leave, for example.
Right.
If it's a contributory plan, they'll need to authorize payroll deductions for their share of the premium.
Makes sense. Got to agree to pay.
And many plans also have a waiting period or probationary period for new hires, often somewhere between 1 to 6 months.
So you don't necessarily get coverage on day one.
Not always. Once you become eligible, there's typically an enrollment window, often around 31 days.
A specific time to sign up.
Exactly. And if an employee misses that initial window, well, they might be required to provide evidence of their insurability, basically, some health information, if they want to enroll later on.
Ah, so it pays to enroll when you first get the chance. Avoid potential health questions later.
Definitely easier during that initial window.
Now, we touched on underwriting earlier. How does an insurance company assess the risk of covering an entire group? It sounds quite different from checking out each individual person's health.
It is fundamentally different, yes. In group life insurance, the insurer underwrites the group as a whole.
The whole company or organization.
Right. They'll consider factors like the overall size of the group, the industry they're in, is it risky or not, and the general demographic makeup, like age distribution.
Okay.
As we discussed, that potential for adverse selection is a key concern for them.
Right. They want a balanced group.
And larger groups are generally more attractive to insurers because the law of large numbers comes into play.
The law of large numbers, right. The idea that with a big enough group, the actual results, like claims, will be closer to what's expected, makes the risk more predictable.
Exactly right. So for very large employers, the insurer might actually waive any requirement for individual employees to provide proof of insurability.
So guaranteed acceptance for employees in those big groups.
Often, yes, up to certain limits, maybe. However, for smaller groups, they might have some basic health questions or limitations. But interestingly, group life plans generally don't exclude employees simply because they have pre-existing physical health conditions.
That's good to know. The focus stays on the group's overall risk.
Pretty much. Another important factor for insurers is something called persistency.
Persistency.
Yeah, it's the percentage of policies that remain active year after year. Insurers prefer groups with a good track record of maintaining their coverage, stable groups.
That makes sense. It costs the insurer time and money to set up and manage these plans, so they want groups that stick around.
Exactly. They don't want groups constantly starting and stopping coverage.
Now, the material also briefly mentioned different risk classifications, preferred, standard, substandard. How do those apply in a group setting if individual health isn't always the main focus?
Well, even though individual health underwriting might be limited or waived, insurers still use these kinds of rating classifications to assess the overall risk of the group.
Ah, for the whole group.
Yes. For example, a group with a younger workforce, generally healthy, maybe in a lower risk industry like tech, might be classified as preferred.
And get better rates.
And could potentially receive lower premium rates as a result? Yes. On the other hand, a group in a more hazardous industry, or maybe with demographic factors suggesting higher overall risk, might be classified as substandard.
And face higher premiums.
Correct. Standard would represent the average risk.
Right.
And, in some rare instances, an entire group might be deemed too high a risk, and coverage could potentially be declined altogether.
Okay, so it's still about assessing risk and pricing it, just applied to the collective, the group, rather than each person.
Precisely.
Now let's talk about some of the really valuable features often included with group term life insurance. One that definitely stands out is the conversion privilege. What exactly does that entail?
The conversion privilege is, a really significant benefit. It gives an employee who leaves their job, whether they're laid off, resign, retire, the option to convert their existing group term life coverage
Convert it to what?
into an individual life insurance policy. And here's the key part. Without having to go through medical exams or provide proof of insurability.
Wow. So even if my health got worse while I was employed under the group plan, I could still get an individual policy when I leave.
Yes, that's the main value.
That sounds incredibly valuable. Real peace of mind, especially if someone develops a health condition.
Absolutely. This is particularly crucial for individuals in that situation. Now, the conversion typically needs to be initiated within a specific time frame, usually 31 days of their employment ending.
31 days. Got it.
What's also noteworthy is even if the former employee doesn't actually complete the conversion process, let's say they pass away within that 31-day period.
Yeah.
The death benefit is still paid out under the terms of the original group policy.
Really? Even if they hadn't finished converting?
Yes. The coverage kind of remains in effect during that grace period, that window.
That's a vital safety net during what could be a really uncertain time.
It is. It's important to know, though, that the converted policy is usually a whole life policy.
Okay, not term life like the group plan often is.
Yes, right. And the premiums will be based on the individual's age at the time of conversion, their attained age.
Which likely means higher premiums than the group rate I was paying.
Almost certainly higher, yes. Because you're older and it's an individual policy, often whole life.
Still, having the option is huge. What happens if the whole group life insurance policy itself is terminated by the employer? Like, the company decides to stop offering it.
Yeah, that can happen. In that situation, if an individual has been insured under the group policy for a certain period, often it's at least 5 years, they also typically have the right to convert.
Convert their coverage.
Yes, to an individual policy, up to the face value of their group coverage at the time the group policy terminated.
Good to know there are protections even if the whole plan dissolves. Now, shifting a bit, who decides where the life insurance money goes when someone passes away? Is that the employer, since they own the master policy?
No, and that's a critical distinction. While the employer holds the master policy, it's the employee, the certificate holder, who has the right to designate and change their beneficiary.
Ah, okay, so I choose who gets the payout.
Yes. This is considered a key incident of ownership that belongs to the employee. So it's the employee who decides who receives the death benefit.
Right.
Now, there is a specific circumstance where an employer can be named as a beneficiary, but only if they have what's called an insurable interest in that employee.
Insurable interest, meaning the employer would genuinely suffer a direct financial loss if that specific employee were to pass away.
Exactly. You remember the example?
Yeah, the source used like a key executive whose loss would really hurt the company versus maybe a part-time clerk.
Precisely. An employer might have a clear insurable interest in that highly specialized key executive. Their sudden loss could significantly impact operations finances.
But probably not for the part-time clerk.
Unlikely. Also, something else to note, in some states, group life policies might include an assignment provision,
Assignment.
which could allow an employee to transfer their rights under the policy to another party. But this usually requires a formal, written agreement filed with the insurer.
Okay, so the employee generally controls the beneficiary designation. That's crucial for personal planning. Now, our source also briefly mentioned other types of group life insurance, beyond just the standard employer plan. Can you give us a quick rundown?
Certainly. We have group credit life insurance.
Credit life.
Yeah, it's specifically designed to pay off outstanding loans, like a mortgage or a car loan, if the borrower passes away, usually decreasing term, matching the loan balance.
Okay, protects the lender and the estate.
Then there's blanket life insurance. This covers groups of individuals who are exposed to the same kind of hazard. Think passengers on a commercial flight, for example.
Ah, so not specific named people.
Exactly. Individuals aren't named specifically, and no individual certificates are usually issued. It covers the group blanket style for that specific risk or period.
Interesting.
And then, of course, we have specialized programs for members of the armed forces, things like SGLI Service Members Group Life Insurance
Huh.
and VGLI Veterans Group Life Insurance, which is often a conversion option after service, and also IGLI Federal Employees Group Life Insurance for federal workers.
So lots of specific programs for certain groups.
Yes, and those often have their own unique rules, eligibility, and coverage amounts.
It's really interesting to see how that group insurance concept gets adapted for different situations. Now let's shift gears to something everyone cares about, taxes.
Yeah.
The bottom line, how are group life insurance plans treated for tax purposes?
Right, taxes. Always important. When it comes to premiums, if employees contribute to the cost, like in a contributory plan,
Yeah, if I'm paying part of it.
those premium payments you make are generally not tax deductible for you, the employee.
Okay, no deduction for my contribution. What about the employer's part?
Employers can typically deduct the premiums they pay as a normal business expense,
Okay.
with one key exception. Sole proprietors or partners generally can't deduct premiums for life insurance coverage on their own lines.
Got it. Now, here's a really key point for employees, right? Something about the first $50,000.
Yes, absolutely. The value of the first $50,000 of employer-provided group term life insurance coverage is generally tax-free to the employee.
So no income tax impact for me on that first 50K of coverage paid by my boss?
Correct. However, and this is important, any coverage amount exceeding that $50,000 threshold, well, the value of that excess coverage can be considered taxable income to the employee.
Taxable income.
Yeah.
Even though I didn't get it as cash.
Correct. It's called imputed income. The value of the coverage over $50,000 based on IRS tables is often added to your income and reported on your annual W-2 form.
Huh. So while it's a great benefit, having, say, $100,000 of coverage from work means the value of that second $50,000 could add to my taxable income. Something to be aware of.
Definitely something to be mindful of, yes. It might affect your tax liability.
What about the payout when a beneficiary receives the death benefit?
Generally, if the proceeds from a group life insurance policy are paid out as a lump sum to the beneficiary, they are received income tax-free.
Okay, lump sum tax-free. That's good.
Usually, yes. However, if the beneficiary chooses to receive the death benefit in installments over time, instead of all at once.
Like an annuity payout.
Sort of, yeah. Any interest earned on those installment payments may be subject to income tax. The principal is still generally tax-free, but the interest portion could be taxed.
Okay, that makes sense. The source also briefly mentioned some other things like retired lives reserve and life insurance and retirement plans.
Yeah, those are more complex arrangements. Briefly, Retired Lives Reserve, RLR, is a way to pre-fund post-retirement group term life coverage. And life insurance can sometimes be held inside qualified retirement plans, like a 401k, but it has to be considered incidental to the plan's main retirement purpose.
Right, those sound like deeper dives for another time, perhaps.
Probably, yes. They have specific rules.
So, to kind of bring it all together, could we just summarize the key differences? Group versus individual life insurance, the main takeaways for you listening.
Certainly. Yeah, let's contrast them. Think of it like this. Group insurance is one master policy covering many people.
Individual is one policy per person.
Right. In a group plan, members typically get the same or similar benefit options, maybe based on salary.
Individual policies can be highly customized.
Exactly. Only eligible members of the defined group can apply for group coverage.
Whereas pretty much anyone can apply for individual insurance subject to underwriting.
Correct. The underwriting, as we said, focuses on the group's characteristics for group insurance.
Individual requires individual health assessment, often detailed.
Yes. Coverage under a group plan usually ends when you leave the group unless you convert.
Individual policy continues as long as you pay the premiums.
And generally, group insurance tends to be more affordable, at least initially, especially for younger folks, and often has fewer upfront restrictions compared to individual insurance.
Particularly for those larger groups where underwriting is waived.
Exactly. Less hassle upfront, often lower cost baked into your benefits.
That's a really helpful side-by-side comparison. So group life insurance, it offers significant advantages, doesn't it?
Yeah.
Convenience, often lower initial cost, that potential to get coverage without individual medical underwriting in many cases.
Definitely key benefits.
But it's so important to remember those roles. The employer owns the master policy, and you, the employee, hold the certificate and that crucial right to name your beneficiary.
Yes. Understanding those roles is key.
Understand the specifics of your group life insurance through your work or, another group affiliation, it's really a powerful step in making informed financial decisions.
Absolutely.
It really makes you think, doesn't it?
Yeah.
Have you actually taken a close look at your own benefits lately? I mean, really, like,
Beyond just the enrollment click.
yeah. What specific questions do you have about your group life insurance coverage? Maybe things you should ask your HR department or benefits administrator.
It's worth finding out the details. The coverage amount, the conversion rules.
Exactly. It's definitely worth taking that second look to make sure it aligns with your overall financial plan. And perhaps, consider whether it actually provides enough coverage for your loved one's needs on its own. Maybe it needs supplementing. Something to think about.